Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia. The webinar today is titled Bond Market Outlook, Understanding Bonds and Navigating the Uncertainties. So good evening, everybody. So my name is Shen Chu. I'm the moderator for this session. Now, what exactly is bond and what exactly is bond funds? I'm sure that many retail investors may find it perplexed to understand the bond market. Today, we're invited two esteemed guests to share with us what exactly are bonds and how do we navigate the bonds market through all this uncertainty period. So before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Today, we are very honored to have two speakers joining us in this session to share with us about the bonds market and also the bond market's outlook. And two of them are respectively from the Opus Asset Management. So the first guest we have today is Miss Bernice Leaw. Now, Miss Bernice Leaw is attached to the Business Development Department as the head of sales for business partners and distributions. She has hands-on experience at middle and senior management levels, namely investment product marketing, project management, and institutional business in fund management industry. Prior to joining Opus Asset Management, she was engaged in multiple project-based work, serving as executive director and board director in two different companies. So today, Bernice will share with us what exactly is bond and what is a bond fund. Moving on, our next speaker for this session will be Miss Joanne Gan. She will come in at the second part. Joanne is an investment manager at Opus Asset Management with more than 14 years of experience in treasury, investment, and research. Holding a bachelor's degree in economics from the University of Queensland, Joanne's dedication to her field is further underscored by her status as a Chartered Financial Analyst Chartered holder and CMSIL holder, demonstrating her commitment to excellence in the financial industry. So welcome both Joanne and Bernice. How are you both today?
Thank you so much, Shane, for having us today. We're doing very well.
Thank you for introducing Shane. Thank you very much.
All right. So without further ado, I will just stop my screen sharing and hand over the session to you.
Right. Thank you, Shane. Let me just share my screen here. Okay. Can you see my screen here, Shane?
Yes, we can see your screen. Perfect.
Right. All right. Without further ado, I shall just start today's session with some intro into bonds as well as bond funds. Let me change my pointers to a pointer. All right. Okay. Interruptions. Okay. Right. Firstly, what is a bond? Bond is simply a fixed income instrument that represents a loan made by any investors and an investor to a borrower. It is similar to an IOU between the lender and borrower, but it includes details of the loan and its payment. Who are the issuers? Typically, governments as well as corporations are the borrowers that issue bonds to raise funds from investors, who are lenders to finance projects or their operations. Now, in return, the investor will receive periodic coupon payments, usually fixed rate, throughout the entire tenure of the bond, and it usually has a maturity date, at which point the principal will be repaid together with the final coupon payment. Now, we'll show this with an illustration. So, investors will provide funds to the issuers or the bond issuers, and the bond issuers will then use the funds to finance business or the project. So the projects will then give income, generate income, and the issuer will pay periodic interest to the investors. Now, what type of corporate bonds do we have? These are some of the examples, not entirely the full list, but some of the examples. We have zero coupon bonds. Sometimes you call them Z bonds. We have convertible bonds. These are the type of bonds that can be converted at some point during the tenure. at a certain price into equity or shares. Perpetual bonds are bonds that don't have a maturity date. It goes on forever. And then you have your additional tier 1, which we call AT1 bonds. And then we have tier 2 bonds. Both tier 1 as well as tier 2 bonds are issued by mostly by banks. And you have callable bonds, asset-backed securities, which we call ABS, and mortgage bond securities, which we call MBS. Now, here are some of the common bond-related glossaries that you may want to know when you read anything about bonds, that you understand what they are. Issuer, we call the company or the government that issue these debt instruments or bonds to borrow money from individuals and corporate investors. We call them issuers. Now, the set value of the bond, which is determined at the launch of the bond, is called face value or par value, and the face value of the bond will never change. Now, market value is the price of the bonds at which it is traded in the secondary market. So the market value of the bond will fluctuate in correlation to interest rate changes, as well as other factors such as credit rating changes. Coupon rate is the rate of interest offered by the issuer on these bonds, and it is termed the coupon rate. Next, coupon value. Coupon value is simply the annual interest paid to the investors. Now, coupon date is the date on which the investors will receive the periodic interest payment. Maturity date is simply end date of which the bond can be redeemed. So maturity date can be short, medium, or long term. Now, the other thing is the yield. Yield is the percentage return an investors gain by holding a bond to maturity. It is called yield. Now, it is based on the purchase price and the coupon. Credit rating, one very important aspect any fund managers, any corporate investors, when they look at the bond, is credit rating. So the top rating agencies such as RAM and Mark will rate different bonds based on their risk level, from AAA all the way to A-. Now, duration, you may heard a lot if you follow any fund house, you may heard a lot when they talk about duration. Duration simply measures the sensitivity of a bond's value to a change in interest rates. So when a bond fund has long duration, it simply means it is more sensitive to any interest rate changes, and therefore it presents higher risk. Short duration simply means it has lower sensitivity to any interest rate changes and hence lower risk. Now, with bonds, you get a regular stream of income. Now, the example given here is with a 3-year bond with a principal value of 1,000 at 6% coupon payable half yearly. So every half yearly, you will get 30 ringgit until the end of the 3rd year. You will get your 1,000 plus the final coupon 30 ringgit. So you get a total of 1,000 or 30 ringgit at the end of the tenure of the bond. Now, there are 3 major types of bonds issuers here. So you have government. The government will issue short-term, i.e. the Malaysian Treasury bills, as well as Malaysian Islamic Treasury bills. These are usually 3 years and below. And the long-term MGS, as well as Malaysian government investment issues. Malaysian government issues, which sometimes we call MGII. These are Sharia-compliant government securities. Now, bank issues money market deposits, money market repo. These are very short-term. And they also issue senior bonds as well as subordinated bonds, such as Tier 2 bonds and additional Tier 1 bonds. Corporations, these are the very common ones in any bond market. They issue short-term papers such as commercial papers, as well as long-term senior bonds, as well as subordinated bonds, which can last as long as 20 years or more. Now, who are the credit rating agencies in Malaysia? So you have RAM, Rating Agency Malaysia, as well as Mark. So the long-term ratings are typically at investment grade, as you can see here, investment grade bonds. Typically, this is from A to up to all the way to AAA. BBB usually is much less. When it comes to BB up to C, these are downgrades. When they go to D, basically it means defaulted bonds. These bonds are not able to meet the repayment obligation. Now, short-term ratings, you have P1 all the way to P3, and we go to NP, that is already junk bonds. D is already defaulted. So for mark, the rating is slightly different. It would be mark 1, 2, 3, up to all the way to 4. Now, some bond examples. So you have government bonds here, MGS, at the coupon rate of 3.84%. Now, government bonds are usually non-rated because they are issued at the government level, and maturity date is up to 2033, 10 years, and the yield to maturity at this point, as we measure it in March, was 3.96%. Now, bank issue bonds as well, as we mentioned before. So, say for example, you have CIMB, GH Berhad, AT1 bonds at 3.6% coupon rate. The rating is A1 perpetual. That means it doesn't have a maturity date. The yield to maturity is 4.53%. And the next, you have corporate bonds, telecom, for instance, giving you a coupon rate of 4.68%. And it has a very strong rating of AAA. And the maturity is up to 2028. And they give a yield to maturity of 4.19%. Yield to maturity means if an investor is holding this bond now, from now until the end, the tenure of the bond, the total return that the investors will get is 4.19%. So it's different from the coupon rate. Now, what are the factors that is affecting the bond's value? Now, firstly, we look at credit rating, the bond terms and structure. Credit is very important, especially credit rating. You will look at credit rating of bonds from A all the way to AAA. That simply gives you an indication what is the repayment capacity of the issuer or of the company that wants to raise money from you. Obviously, AAA has the strongest ability to pay you back. AA a notch lower, A another notch lower. Another thing that will affect the pricing of the bond is you look at MGS. Where is the MGS rate currently? And if the MGS rate, the risk-free rate is high, then the bond pricing will always have to take into consideration of the risk-free rate. So currently, the risk-free rate of a 3-year MGS, we call it the Malaysian government securities, which we call MGS in short, is 3.46%. So which means when a corporate wants to issue a 3-year or 5-year bond, they will have to make sure they deliver better returns than the MGS risk-free rate. And the tenure, 1 month to 30 years. Obviously, the longer the tenure, the higher the uncertainty, and therefore the company or the corporate that issue the bonds will have to give you higher interest to compensate for the higher uncertainty over the longer term. Now, other things that we look at will be the bond liquidity, how easy it is to sell in the secondary market, what is the supply outlook, what is the macroeconomic and industry outlook. So in the industry that we know, let's say in the green energy, that we know the outlook is bright and clear, obviously this corporate issuer do not need to give you a higher interest in order to entice you to invest in this bond. Now, this is an illustration of yield to maturity. Say, for instance, at current, the FD rate is 4%. The coupon rate is 4%, and the price of the bond is 100, and yield to maturity at this point is 4%. Now there is an OPR hike. Because of the OPR hike, FD now is 5%, and the yield to maturity now is raised to 5, because we know when OPR increase, when interest rate increase, the bond prices will drop, and therefore the yield will increase. So bond prices are always inversely related to yields. When price of bond goes up, the yield will go down, and vice versa. Now, yield to maturity, as we mentioned before, it is simply the rate of return an investors will receive, and it rises or falls depending on the market value, which is here, and how many payments remain to be made by the corporate issuer. Now, this is a very clear chart to show you when interest rates goes up, the bond yield will, the bond prices will goes down, and therefore the yield will goes up. So if you look at this line here, this is the line as of 31st July last year. And this line here, this black line was as of 31st July. So you can see as the Federal Reserve raised the interest rate, the bond prices goes down, and therefore you can see the rate, the yield of the bond, the US Treasury bills have risen accordingly. So likewise for Malaysian government bonds. Now, a look at the Malaysian government bond market. So the total outstanding bonds in Malaysia as of right now is just a little bit below 20 billion. I can't see this. So Malaysian bond market is one of the largest and most developed in the region. And you may be interested to know, as far as SRI Sukuk is concerned, Malaysian bond market holds the largest or the most amount of SRI Sukuk in the world. 172 out of active SRI Sukuk bonds in the world was actually hosted by Malaysia out of 192. Now, if you look at the Employees Provident Fund, almost half of it, I would say, including money market, actually half of it is in fixed income. 42% of it is in equity. Now that makes sense because EPF money is meant for security. So having half of the investments, the funds invested in money market and as well as fixed income gives a lot of cushion and security and a lot of safety to the EPF money that we have with EPF. So we saw a lot of bond inflow, a lot of foreign inflow into Malaysian bond market for the first half of 2023. Up to June 2023, we have cumulative flow of 21.2 billion into Malaysian bond market. And that's why a lot of bond funds in Malaysia were doing very well for the first half of this year. So who are holding Malaysian government bonds? So you have asset management company, that's fund management company. You have central bank, governments, pension funds, as well as bank, insurance companies. These are the buyers of Malaysian government bonds from foreign countries. So investing in bonds. Why would you invest in bonds? What is the role of bonds in a portfolio? In any portfolio, actually. Firstly, is capital preservation. That explains very well why EPF have half of the EPF funds into fixed income, because that's for capital preservation. And second is for regular income. As we mentioned before, a bond gives regular payment, usually half yearly, to the investors. So with that, we get regular income. Capital appreciation. So when a bond gets upgraded, say from A to AA, the bond may get capital appreciation because now it has better credit rating. And fourth, diversification. So if you put all your money into equity or other forms of investment, those tend to be more volatile and higher risk. So you will put in bonds, which will reduce the risk substantially to a portfolio. And this is exactly what happened to your EPF. Why you are able to get 5 to 6%, that's because you have bonds in your portfolio. It is also a potential hedge against economic slowdown or deflation. So that is always the case when an economy is slowing down or going into a recession. People or investors will always go into fixed income for safe haven rather than going to equity, which tends to be more volatile during those times. Now, what are the ways that you can invest into bonds or bond funds? Number one, direct. You do it yourself. You buy into the bonds yourself. So for a bond, typically one standard lot is 5 million. If you want to buy into Malaysian government bonds, it's standard 10 million. So the next way for you to do it will be via a fund managers. You invest into a bond fund. So what do you need to do if you are to do it yourself? Yeah. Firstly, you need to do macroeconomic analysis. Secondly, you need to do credit analysis. Thirdly, you need to do sector rotation, because during different economic cycles, there'll be sectors that are doing well. There'll be sectors that tend not to do well. There'll be sectors that are sunset sectors. So you look at sectors, which are the sectors that are likely to do well in the next year or next 2 years or next 3 years. And then you do sector allocation and sector rotations accordingly. And next, you will analyze the market. Is the market going to be the fixed income market do well for the next 1 year, 2 years? What are the macroeconomics indicators telling you? And then next, duration management. So if you expect the interest rate is going to go down, are you going to have long duration or short duration? And then risk management. What kind of risk management are you going to take in order to ensure you minimize the risk for your portfolios? So there's a whole lot to do when you want to invest directly into a bond. Now, the main risks relating to bond investment, the first one is credit risk. Credit risk simply is the creditworthiness of the bond issuer and whether it has ability to repay you the debt, whether it's periodic coupon or the ultimate repayment of principal at the end of maturity. What's the probability of default? Will the creditworthiness weaken? Will it have credit downgrade? And the next is liquidity risk. How easy it is for you to sell the debt in the secondary market near its fair value so that you don't make losses. Now, if the liquidity of the bonds gets is harder to sell, then between the bid and ask price, the spread will get widened. So you will not get a fair value for the bond that you want to sell. And interest rate risk. So you've got to manage the interest rate movement direction and manage your portfolio accordingly. Next is the inflation risk. So if the inflation rate is increasing higher than the bonds yield, then it will give you a negative real rate of return, which is something that you want to avoid. Now, the common types of credit risk. Now, firstly is default risk. That simply means that the bond issuer is not able to pay you back, whether they pay you the principal or pay you the coupon. Next is the downgrade risk. So the bond issuer suffers a decrease in its creditworthiness, its ability to pay you back reduced, and therefore the mark or RAM rating agency give it a downgrade. And next is the concentration risk. Do you have all your bonds or most of the bond in one or two sectors? So if that sector suffers, if the economy is going down, then your portfolio will suffer massive losses as well. So challenges. So as an individual investing directly into bonds, what are your challenges? One is limited access because most of bonds are not listed. It's traded over the counter. And the standard trading size is big. It's either 5 million for corporate bonds or 10 million for government bonds. Next, because it's over the counter, so individual like you and me, we have limited access to this kind of to the information, and we have limited access to over-the-counter trading. And limited time. Do you have the time and resources to analyze, to do the analysis that I mentioned just now? And do you have the time to continuously monitor the bond on the bond issuers and the market? And bear in mind, the key investors, the major investors in the bond space are typically EPF, banks, unit trusts, fund management company, and such as this. So the investment banks will typically approach these people first before you even have a chance to have access to these kind of corporate bonds. So what about investing in the bond funds? How does it work? So as an investor, you invest in the bond fund, and then the bond fund managers will do a series of analysis before buying the bonds. And the bond fund managers will then buy bonds using the pool of money that you get from you, and will buy bonds, and the bonds will generate income, the periodic coupons that I mentioned just now. And plus the realized gains from selling the bonds, you get total return to the investors, which is you. Now, what does a fund manager do? So the fund manager, as we mentioned just now, we analyze the economy situations, the global economy, the regional, as well as the local, and then analyze what will all this have, what kind of impact it will have on the fixed income market. And then they decide what is the maturity structure, what kind of duration it decides to have for the portfolio, and what kind of sector allocation, what will do well for the next 1 year or 2 years or 3 years. And then after that, it goes to decide what kind of bonds, which bonds will go into the portfolio. So before doing that, the fund manager will do a credit analysis, analyze the bond issuers in terms of the corporate structure, the credibility of the owners, the top management, and the whole list of their credit repayment background, whether do they have credit, they have been repaying timely, and the whole list of analysis that the fund managers will perform here. And this is not the end. Throughout the entire tenure, the fund managers will have a certain self-discipline that he needs to follow. He needs to monitor the economic and sector outlook and the changes in it, any deteriorating credit conditions in the market or in the particular bond, or any mispricing in any bonds in the market that's worth buying. So these are the things that typically the fund managers will do on a day-to-day basis. What are the benefits of investing in the bond fund? Firstly, you get regular income and potentially higher returns than FD, especially if you're corporate and you get tax-exempted return from the funds. And fund manager will ensure the risks are mitigated, which these are things they do not have time to do as an individual investors. And you diversify your portfolios. So you don't have just all your funds, all your money invested in equities, you diversify into bonds to mitigate your risk. Liquidity, that is, if you want to buy a bonds, direct bonds, to sell it in the market, you may not have the time. But when you sell it, when you buy or invest into a bond fund, you can redeem or withdraw anytime to cater for your liquidity needs. There's no lockup period, no early withdrawal penalty, so you can withdraw the money anytime that you need it. So you can see here the risk return characteristics of various kind of investment. So FD obviously has the lowest risk here, and bonds here and equities that most people like have the highest risk and obviously the highest return as well. Bond fund is sort of in between because you invest into a diversified portfolio of different kind of bonds, and therefore the risk that you have is much lower compared to if you buy just one single bond. You can see here, compare this is one same company. Now, in the share market, the share price may fluctuate drastically, but if you look at the bonds, the bond value or the bond prices remains quite steady, while the equity performance is not fluctuates highly throughout the period. So that's why we always highly encourage the investors should always have a balanced portfolio between having fixed income as well as the equity. So factors affecting the bond fund performance. Any change in interest rate, as we mentioned just now, the price of a bond will move in the different directions of the market interest rate. So when market interest rate move up, the bond price will fall and vice versa. Now, funds duration, as we mentioned just now, the higher the sensitivity, when the duration is going up. So say, for example, a duration of 4 simply means a 1% interest rate rise will cause a 4% drop in the fund. Sector allocation. So if we put in the right sector, then the performance of the bonds will do well. So we always say fund performance is always attributable to a fund manager's ability to pick the right securities as well to do the right sector allocation. Credit ratings. So if a bond's credit rating get downgraded, the bond becomes less attractive to investors and the price will fall, and therefore the fund's value will fall as well. And vice versa, if the credit rating is upgraded, the bond price will go up and the bond fund will benefit from a higher value as well. Market conditions, likewise. So if there's a stock market run, the stock market is rising, typically the investors will move out of bonds and into equities. And by contrast, vice versa. So if the bond market, the stock market is going through a correction, or let's say the economy is going down, the bond market, the stock market is going down, investors may seek safe haven from bonds. Now, the difference between bond and bond funds. Maturity, bond has a maturity, whereas bond fund doesn't have a maturity. income payment. Usually bond will give you a fixed rate, paid either annually or semi-annually. Bond fund may pay you a income payment either monthly, quarterly, or yearly. It depends on the respective bond funds. So the quantum of the income declared may vary as well. Principal protection, bond, as far as bond is concerned, capital repayment upon maturity is not guaranteed. But for bond fund, the value depends on the market value of the unit trust at the time of sale. So what assets make up wealth? So if you look at here, this is for people who have 10 million above, 100 million above, and 1 billion and above. So it is very clear that fixed income investments become a significant asset class or investment base for those with 1 million net worth here and above. So as for these people, these folk in this area here, the key for them is to preserve. Whereas for most of us here, with most of the people with 1 million net asset value and below, the key is to grow, and therefore it makes sense for them to have more equity or even residences. Here, the focus would be more for bonds. Now, that ends my presentation for today. Now, on to you, Joanne, the bond market outlook. Thank you.
Hello, thank you so much, Bernice. Let me just share my screen now. Okay, so thanks everyone for joining our session today. And this is going to be the title of my session, which is the first half 2023 market review and bond market outlook. And the title is Navigating Through Uncertainties. So my session is going to split into three parts, where I will talk about the first half 2023 global and domestic market review, followed by the Malaysian bond market, and also kind of like to conclude both slides as well. So you can see that first half of 2023 in terms of domestic and global market review, I have 3 points here. So number one is that growth is trending lower, but remain resilient so far. And you will see that in the next couple of slides, I will also show you what we mean here. And on number two, inflation is moderating, but risk to upside from rising energy and food prices. So number three also talks about central banks continuing its rate hike path, but you can see that in 2023, they have become a lot less hawkish compared to what they've done in 2022. So this chart, you will see here that global growth has eased in first half of 2023, but has remained resilient. So if you just look at the chart over here on my left, you will notice that the trend is such that it is trending lower, but you can see that in the last couple of months, last quarters, the numbers are still positive. So US GDP growth is at 2.4%, Eurozone at 1% quarter on quarter, China GDP growth at 0.8%, and Japan has been very strong at 6%. So global economy has slowed down, and you can see notably at Eurozone affected by slower consumer spending, and China has been recently impacted by the latest headlines on their property market and also an issue with their youth unemployment. On US itself, you can see that softness is seen in the US GDP growth from the impact of higher Fed funds rate, but the economy has so far avoided a recession, although there are a lot of economies, a lot of traders out there who thinks that US might see a recession, but so far they've missed it. The market remains quite robust. The IMF, which is the International Monetary Fund, expects global economy to grow by 3% in 2023 and 2024. And you can see that last year, world economy grew by 3.4%. So to talk a bit more about IMF's projection, here you can see that IMF global growth projections improved in its July outlook. So IMF comes out with a projection update every other quarter, and you will note here that for world output, 2023 is 3%. And in 2024 is also 3%, and this is 0.2% higher than it was in April. So where is this growth coming from? It is from advanced economy at 1.5% in 2023 and 2024 at 1.4%. But the main bulk of the growth will be coming from emerging markets and developing economies, coming from China especially and India as well. So next, I want to talk about US economy. Earlier, I spoke about how robust the economy is, and you will see that in the second quarter of 2023, the GDP growth exceeds consensus driven by consumer strength. So the last 4 quarters of GS GDP growth has been positive, as you can see in the chart here, and this is coming from personal consumption and also non-residential fixed investments. In China, the picture is slightly different because you can see that confidence in China recovery is declining, with indicators broadly missing expectation. So if you just follow me on the chart here on the left, you will see this is a credit default swap. And what a credit default swap is what a trader would pay to insure themselves against a default on China. Similarly, like with all insurance premiums, the higher the risk, credit risk of what you're insuring against is, the higher premium you have to pay. So you can see here that it has gone up significantly in the last month, and it has gone up a lot, showing that the confidence in China is declining. And on the right-hand side, if you look at some of the things that we track, which is fixed asset investment, retail sales, and industrial production, the numbers are looking positive and looking quite strong. But again, if you look at the trend of how the numbers are, you will see that it is trending lower towards the latest month in 2023. So in Malaysia, we saw somewhat slower growth in second quarter of GDP growth in this year, but remains well supported by private consumptions and investments. So if I just push 1 quarter back in first quarter of 2023, where we saw a growth of 5.6%, you will see that this is coming from private consumption, 5.9%, and also investments at 4.9%. In second quarter, you can see that private consumption remains positive at 4.3%, so is investments at 5.5%, and you can see also an improvement in government spending of 3.8%. So overall, our view on the Malaysia GDP growth for 2023 is between 4 to 5% this year. So we want to see what sort of sectors are doing well this year and what are sectors that are not doing so well this year. So here you can see that the global manufacturing purchasing index remains below the threshold expansion mark of 50 for 4 consecutive months. And I think the keynote here is to really look at the trend again, that it is trending lower. And how we look at this number, this is a soft number, so you can see that anything that's below 50 marks sort of like a contraction in the sector that we're looking at. So for the global manufacturing PMI, all the numbers are below 50. PMI globally is 48.7, US at 47, China at 49.2, and Europe at 43.7. So why is it slowing down? So one of the reasons that it is slowing down is because after COVID, economies reopening, there's a bit of shift in terms of spending on goods and services to services as well. And you can see here that the slowdown in industrial production has been accompanied by marked weakening in world trade. So when global world trade, global growth comes down, you will see that this manufacturing sector activity will also trend down. There's also weakening in world trade reflected in recent trends in imports in the US and Europe. So all this weakness in the manufacturing sector just kind of supports a moderate global growth outlook for this year. For services sector, we see that they're still resilient, being the key driver for GDP growth in 2023. So it's very similar how you look at both manufacturing PMI and also services PMI. Again, 50 is the magic threshold here, where above 50, it's showing an expansion in the sector. So you can see that the global services PMI is 52.7, US also growing at 51, China also growing at 54.1. But we do see that Europe has dipped down in terms of services at 48.3. So global services PMI remains very robust as consumers' behavior change from them buying a lot more goods and service, a lot more goods when they were at home. And now that the market has reopened, a lot of people can go out now and spend on F&B and tourism sector instead. So what exactly are PMI services? It is a service data based on surveys in private sector companies covering sectors like transport and communication, financial intermediaries, computing, hotels, and restaurants. So we do expect that the service sector will be the key driver of growth in 2023. So next we'll talk on inflation. So here on my slide, I have 2 different inflation, which is the headline and core. So I'll go to the headline first. I think here again, the trend is very supportive of where central banks want rates to be at. So most central banks are targeting an inflation of about 2%. And you can see here that all the countries that we track is trending towards the right direction. So US CPI is 3.2%, Eurozone at 5.3%, UK at 7.9%, and Malaysia, June numbers are 2.4%, and the latest July numbers has come even down even further to 2%. So on core inflation, which is actually inflation stripping out volatile items like energy and food prices, you can see that it's slightly mixed across the countries that we're tracking. So I think the one that has been increasing is in UK, where it's still 6.9%, really high from a target. And you have US core CPI at 4.65%, Eurozone at 5.5%, and in Malaysia, core CPI is at 3.1% as of June. Again, the latest July number has come down to 2.8%. So this is, especially on Malaysia, it is within the Bank Negara's target for this year of 2.8% to 3.8% for inflation in 2023. So next, I just want to talk a bit more about central banks and what they have done in 2022 and also what they have done in 2023. So here on the left chart, you can kind of see that it's split into advanced economies on the top, US, UK, and Europe. And at the bottom, we have China, and then we have Malaysia, and so the countries within the region of Malaysia. You can see that for countries that had the most inflation issues last year are the countries that were most hawkish last year. So US hiked 4.25%, UK 3.25%, Europe 2.5%, and in the region, you have seen that Indonesia hiked 2% last year, and Philippines 3.5%. In Malaysia itself, Bank Negara has been quite gradual in terms of their rate hikes with only 1% last year. And this year, tracking 2023, Bank Negara hiked 0.25% in May. And you can see for the other countries, US, UK, and Europe are still quite hawkish in 2023. But if you compare the lighter green and the darker green chart, you will see that the hawkishness has kind of halved this year. So US hiked 1%, UK and Europe both 1.75% this year. And I think within the region, you can see that everyone has kind of slowed down this year as well. So moving on to my table on the right, it's just all the countries that I'm talking about. What is their latest move in their decision making? What is their latest policy rate? And what is the outlook and their core inflation? I think you will kind of see quite easily here that countries that still have high core inflation are the countries where the outlook is that they will hike further for this year. So UK, US, and Europe, they've hiked 25 basis points in the latest decision, and the outlook is for them to hike further to kind of bring down inflation to the target that they want it to be. In China, I think for China, they want to boost the economy. So we have seen kind of like the opposite of what the central banks that have been doing. For China, they have cut rates 15 basis points. This is on their one-year medium-term lending facility to 2.5, and the outlook is that they will cut further by 10 basis points. Malaysia, our view is that it will hold at 3% at the rate that it is at right now. And for the region, I think you will also see very similarly, the latest is mostly on hold, and the outlook is for them to hold as well. So next, I'm going to talk a bit about Malaysian bond market on my next segment. Number one would be that Malaysian bonds outperform the US and emerging market. Number two is that there's strong demand in the bond market from foreign inflows and domestic institutions. And then MGS, which is the Malaysian government bond supply, is expected to increase, while the corporate bond supply is remaining quite low so far. Okay, so here we kind of have like a heat map to show the past 10 years, where have all the different asset classes, how have they performed? And I think I also want to point out here in what's highlighted is the BPAM All Bond Index. It kind of tracks how, if you're invested into the bond fund, what would be a return this year. So the Malaysia All Bond returns outperform peers substantially in like the fixed income space year to date at 4.7%. You can see here that US Treasuries perform only 0.1% positive this year. And so to show like how strong and robust the fixed income space is in Malaysia. If you go on to the equity market, you will see that, however, our KLCI has actually underperformed some of the other global indices. KLCI return year to date is negative 1.6%. If you compare to like the MSCI World and S&P 500, they would have returned double digit this year. One of the key underperformance would be from commodities. Year to date, due to price normalization post-COVID reopening. You will see here also gold and Brent are actually quite flat as well in terms of their return. But one thing that I do want to point out is that in Malaysia, the ringgit bond market has the lowest volatility. So the last one here, the last column here tracks volatility. So the lower the number, the lower the volatility. And the ringgit bond market is 2.6%. And you will notice also that there's only 1 year of negative return, and this during the COVID times in 2021 of negative 0.9%. So kind of zoom down into like bond markets performance like last year and this year, you will see that bond markets are performing a lot better in 2023. So if you go globally, you will see that last year, 2022, it performed negative 16.2%, and this year is positive 0.3%. But again, zooming into like what's important is that Malaysia market remained quite robust. Like last year, 2022 returned a positive of 1.5%. Again, this year, 4.7%. And you will see also in Indonesia this year, they've also returned about 6.2%. So we're just going a bit more into how the bond market has performed in Malaysia. This is the government bond yield curve, which is typically upward sloping. You will notice that holding a shorter bond will give you lower yield. And if you were to take more duration or hold a longer yielding tenor of a bond, you will be paid higher as well for holding that risk. But all in all, I think I just want to show you how a year ago, as of 31st July, being the purple line against 31st July this year, you will see that the entire yield curve has shifted lower. And again, for the bond market, when yields come down, the price of the bond will go up. And this is why it's been positive performance for the bond fund this year. So I think this is a slide that Bernice shared earlier, but I think I just want to focus a bit more again, why foreign holdings is something that we track so closely as a fund manager and why is it important as well. You can see that year to date, the foreign investors inflow has been positive in the bond market. This is the gray part of the chart here. And this is also a reason why our bond market has rallied this year, both from foreign investors, from them having more confidence into the Malaysian market, and from domestic investors as well. But zooming just straight again into who are the holders of the foreign holdings, why is it so important to track them is because we do like stability in the bond market. So for asset managers who are in the Malaysian bond market, they typically track benchmark indices, and they're also quite sticky. Central banks, pension funds, and insurance companies are sticky as well. So I think to note here is that those investors who are more traders, who are less sticky, they have already left the Malaysian market. So the ones that are remaining in our market are really long-term holders, and this will bring stability into our bond market. In terms of corporate issuances, first half of 2023, you see that it has been well diversified across sectors of all different sectors. So this pie chart here on the left, you will see that they are mostly on infrastructure and utilities, about 30%. So infrastructure and utilities are like infrastructure in public transport, like the MRL, like the RRT that you see. And real estate will be into the property bond market. Financials are like banks and any company that gives out financing. Quasi-government will be from Chagamas. And you can see that across all the other sectors, it is actually quite well diversified as well. This is why we're saying that the Malaysian bond market in terms of corporate bond issuances are very robust as well. You can see that with the economy picking up this year, there'll be lots more issuers who'll be issuing bonds in the bond market. So on the right here, we also track how much of bonds are issued this year. So 2023 year to date, you can see that gross and net are actually quite good numbers. But we do hope that for the second half of this year, that it will also track and also be able to catch up to how robust the market was last year. So hopefully for this, for the second half of the year, we're quite confident that there'll be a lot more issuers issuing into the bond market. So next, I want to talk a bit more on government initiatives. I think this is something that all of us are quite aware of. We see that government initiatives to provide midterm growth prospects. And I think some of the key initiatives that our PM has actually announced also brought confidence to the market from foreign holders as well. So we have the Madani economic narrative. Some of the key points here, we've also listed down to boost digitalization, set aside for infrastructure, industrial green zones, also loosen some visa program rules, and to set aside 5 billion ringgit to provide financing guarantees for first-time buyers. So all these are very supportive of the local bond market in terms of especially green zones, and also for helping a lot of buyers buy their first house as well. So this is good for the property market. In terms of the National Energy Transition Roadmap, this is something that is to do with renewable energy and to make a lot more greener in terms of ESG growth prospect as well. Some of the key points is that you will see that there are a lot of flagship projects, and some of the reason for this is to create job opportunities and also a reduction in greenhouse gas emissions for this year and moving forward as well. So why are we so excited about all of these government initiatives? Is because both the Madani economy and the NETR is going to boost investments into technology and utilities, and also increase sustainable debt issuances. So on the right here, it's something that we track in terms of sustainable debt issuances in Malaysia, and this is cumulative from 2017, and we've got this data from IMF. So by sector, you can see that most of the sustainable issuances are in financials. So again, with the Madani economy, with the NETR, it's very exciting because there are going to be lots more issuances in other sectors, such as like utilities, energy, and also property. So again, having more sectors, having more diversified sectors into sustainable debt issuance is something we as fund managers like, because then we can invest into a more diversified portfolio for our clients. So kind of summarize my presentation today. Again, number one, growth outlooks, we do see that it's diverging in the near term. We see some economies displaying really strong resilience, especially in the US. In Malaysia, we are normalizing to our typical 4 to 5% return for this year. And some are disappointing. You can see that China, although the growth is about 4 to 5%, but I think numbers coming out from China has been disappointing, has had like underperformed as well. And you can see that Eurozone having issues in growth and inflation. So number two is that we expect interest rate hikes to end for most countries by second half of 23 and to remain high there for longer going into first half of 2024. And earlier we spoke about the potential for more sustainable debt issuances, and this will come from sectors such as financial, utility, and property sector. So we as fund manager, how do we take opportunity of where we see the economy going, where we see where the economy is right now? Number one is that for the second half of this year to the first half of next year, a strategy would be to continue to take advantage of higher interest rates. So we'll buy like bonds at yielding higher so that the yield on our portfolios are going to be quite good as well for our investors. And then moving forward in the second half of 2024, if there's any rate cut cycle, again, when yields come down, price go up, again, it's going to be very good for performance of bond market. And lastly, we do expect that the bond market performance to be positive this year. This is supported by local institutions and foreign investors. So with this, I end my presentation. Thank you so much for your attention.
Thank you so much, Joanne and Bernice, for sharing with us what is bond and what is bond fund, and also the outlook for the bond market. So if you have any questions to ask our esteemed speakers today, you may write them at the Q&A box, not the chat box, okay? Write them at the Q&A box. So we address your questions accordingly. So the first question I see on my screen is asked by Wing Kian. What is Sukuk? Is it a government bond? I would like to pose this question to Bernice.
All right. Okay. Thank you, Mr. Leong, for asking this question. Right. Sukuk, in very simple term, is Sharia compliant bonds. Now, I managed to find that here. The key difference between Sukuk and bond is that Sukuk means an ownership of an asset. So when you buy a Sukuk, you own the asset behind the Sharia compliant bond. Now, when you buy bond, any normal bond, it is a debt obligation of the issuer to you. They owe you money. And the next thing is the asset underlying that particular bond under a Sukuk is Sharia compliant. It has to fulfill certain Sharia laws. Whereas for a normal bonds, the common bonds, the assets backing these bonds do not need to be Sharia compliant. It can be even in gaming, in tobacco and things like that. Now, as far as Sukuk is concerned, it is priced according to the value underlying that particular bonds or Sharia compliant bonds. As far as normal bond is concerned, the bond pricing, the prices or value of the bonds is based on its credit rating, whether it's A, AA, or AAA. Now, the sukuk, the price of sukuk can increase when the value of the assets increase. Whereas on the corporate bonds or other non-Sharia compliant bond, the value of that comes from the interest, and is making riba. So riba is not Sharia compliant, and the performance of the underlying asset does not affect the bond prices at all compared to the sukuk. And the next thing is, as a bond investors, when you sell a sukuk, you're selling ownership in the assets backing them. Whereas when you sell a bond, a normal corporate bond, you're selling the debt. So that's the key difference between bond and sukuk.
Thanks so much, Bernice,
Yep.
for the clarification. Thanks, Bernice. I think that's very clear.
Thank you.
The next question is by Sue. In regards to the fund duration rating that Bernice you showed just now, who determines the rating? Does a 10-year bond have a rating of 10? You're on mute, Bernice.
Okay. Now, Shun, as far as the bond duration is concerned, it is not measured in terms of rating. We typically measure in terms of years, a bond portfolio duration of 1 year, 2 years. A bond, we measure in tenure. Does it have a 1 year tenure, 3 year, 5 years, 10 year, 20 years? Duration is typically used to describe the sensitivity of interest for a portfolio of a number of bonds. So a duration of 4 for the bond portfolio simply means a change in 1% of interest rate will bring about another 4% either up or down for the particular bond portfolio. So who determines the duration of the bond portfolio is the fund managers. The fund managers will look at the interest rate environment, the interest rate outlook. Is the interest rate going to go down or going up? So in the interest rate environment where the interest rate is going up, the fund manager typically will prefer to have a shorter duration, because when interest rate goes up, the bond value will go down. And so if we want to have a lower impact, the fund manager will have shorter duration for the bond portfolio. Now, if the interest rate is, we see the interest rate is likely to go down, so what happens is then the fund manager will increase the duration of the portfolio, because when the interest rate goes down, the value of the bond will go up. So that's how we determine the duration of a bond portfolio.
I see. So does that mean that a 10-year bond is more sensitive to interest rate in such that there's 1% hike in interest rate will cause that 10% change in the price?
That will refer to the bond portfolio rather than a single bond. Now, obviously, likewise, we say just now, if the bond has a longer tenure, it tends to have greater uncertainty. So when there's changes in the economy and interest rate, it tends to be experience a higher impact as well.
Right, understand that. Thank you so much, Bernice. The next question is by Kok Long. What is the minimum amount that a private individual can purchase?
Kok Long, are you referring to investing directly into bond or bond funds? If you're referring to investing directly into bonds, if you to buy the entire standard lot, then usually it's 5 million for corporate bonds, 10 million for government bonds. If you are a client within the private banking, then you probably be able to buy a non-standard lot of 250,000 sometimes.
Okay, so the bond distributed by private banking are through the relationship managers, right?
Yes. If you are to invest into bond funds, then typically, if a unit trust funds will be 1,000. If it's a wholesale fund, which is meant for sophisticated investors, it can be 10,000 above, depending what's stated in the info memo.
All right. And we also have the exchange traded bonds and sukuk listed on Bursa Malaysia.
Right. Yes.
That one probably 1,000 and above. You can get one lot. The next question is by Farid Unku. How are risks mitigated in bonds, like inflation risk, payment risk, as such?
Joanne, would you like to take these questions?
Yeah, okay. Hi, Farid. Thanks for your question. So, okay, how is it mitigated? So I think the first one, Bernice has actually explained one of the um on inflation risk. I think when we do see that inflation is very high, so I think just now in my outlook, you will see that when inflation is high, central banks tend to also hike rates quite substantially to control inflation. So when yields go up, I think the price of the bond will come down. So as a fund manager, how we kind of like mitigate this risk is to reduce duration of the portfolio so that again, the lower your duration of the portfolio, the lower the volatility is to the return to the portfolio. And on your second part on payment risk, this will be something that every fund manager, so every fund house will definitely have their own fund managers and have like a team of credit analysts to look into the credit risk of each bond that you purchase. So for example, for every issuer, we actually go through like things like qualitative factors like the management, their strategy, and you look at quantitative factors like the financial performance of the company. So only when, as a fund manager, as an analyst, you do feel that the risk that you're taking by giving money to this issuer when they issue a bond, that is only be something that you have to decide that is going to be something that a risk that is worth taking, and you will have like a foreseeable future for the duration that you hold the bond, that the issuer will not default during that time. So as a best effort basis.
All right, thank you so much, Joanne, for the clarification. The next question is asked by Oi. What if the bond issuer can't pay the interest and the company goes into Chapter 11, such as Serba Dynamic? Do the bondholders get back anything?
Okay, I think I'll take this question as well. So going again into like credit risk. Okay, so if a bond issuer cannot pay interest, I'm also assuming that they may not be able to pay the original principal as well. So what happens, like for example, Dynamic or any other bonds that has issues paying their interest and principal, so then the sukuk holders or like the bond holders, we have to come together with like a trustee and to decide what to do. So for example, if let's say there is non-payment of interest and non-payment of principal, it can go into an event called the event of default. So following an event of default, you will see that the bond that's rated by either RAM or MARC, they will also classify the bond as D, which is a default. And then moving forward, what happens is that the bondholders will come together to decide what is the next action plan. So one of it is that the company can be liquidated, and then the payments will just follow the ranking of order of the security. Like for example, if you're a bondholder who has a security against a building, then when they actually liquidate and sell the building, then you will be paid as well, depending on how much they sell the building. And secondly, it can also be you appointing a receiver, a manager, an R&M to just take over the company and try to see what's best for the company, whether it can continue business as usual or not, or again, it can also go into liquidation. So just summary again, so will bondholders get back anything? It depends on the bond that you have purchased, whether again, any security, and if it's a clean unsecured, then you have to see what can you do to liquidate a company and what is the cash balance of the company.
Thanks so much, Joanne. The next question is by David Yong. Is the local bond market likely to underperform others given the relatively lower Malaysian interest rate currently?
Okay, I guess I'll take that too. Okay, sure. So thanks so much for the question. So okay, actually, earlier you have seen my slide that the Malaysian bond market actually outperformed a lot of the other countries. Again, year to date, our return for the bond market is 4.7%, compared to US Treasury, where it was quite volatile. It was 0.1%. So I think it definitely outperformed the US market. I think it will also outperform countries where interest rates are hiking, because as countries are very, very hawkish, yields go up, again, it will definitely impact prices of the bonds, where the price of the bond will come down. and underperform. So in the Malaysia, our interest rates are actually relatively okay. You can see our OPR is 3%, and then our 10-year yield is about 3.8%. If you invest into our bond funds, I think we have a view of about 4 to 5% in the next 12 months for returns in the bond market. So I would say that it is unlikely to underperform others now because of the stability in the Malaysian bond market, on the demand into our bond market. I think those two factors are just going to support the bond market performance in Malaysia.
Thanks so much, Joanne, for addressing the question. The next question is by Nurul Anhar. How much are the percentage by market shares between the sukuts and the conventional bonds in Malaysia so far? Any of you know the statistic?
I don't have the statistics to say, but we can certainly find out and send to Bursa so the Bursa can answer Nurul.
All right. Thank you so much, Bernice. For the next question by Farid Unku, for Malaysia issue bonds, are political risk considered? Maybe Joanne, take the question.
Yeah, okay. The simple answer is yes. Political risk, I think, would impact foreign holdings. I think you will see that prior to state elections, I think the market was a bit jittery, a bit worried because we're not sure of what the outcome would be. I think similarly last year before we had our general election, again, in the bond market, when there is uncertainty, definitely people stay away. So did you see, like, after a GE election, after the appointment of our latest PM, you will see that for this year, every month there's been like foreign inflows into the bond market. So yes, political risk is a reason, because foreign holders want stability in a market that they're investing into.
Thanks so much, Joanne. Bernice, just now you told us that how we can buy bonds. So the next question by Kot Long is, can we sell the bond earlier before its maturity, and how can we sell them?
Yes, if you buy bonds directly, certainly you can sell the bonds before its maturity. Now, if you buy one standard lot, then if you're buying through your private bankers, you can sell it back to your private bankers. They will find buyers for you. If you invest into bond funds, it's anytime. You can just redeem with a form. Now, if you're to buy yourself via other platforms instead of via your private bankers, then you need to find, you can only sell it when there's ready buyer in the secondary market. Yeah.
Thanks so much, Bernice. The next question is by Vijayanara. Why is there a sudden surge of foreign flow into the bond market in Malaysia lately? Maybe Joanne, you can take the question.
Yeah, hi Eugene. Thank you so much for your question. So I think earlier I've also mentioned in terms of political risk. So after our GE elections, after appointing the government and also our Prime Minister, there is stability in the Malaysian market. And also recently with the PM announcing Madani and also NETR strategies, those are strategies that I think foreign holders do like, because it just brings stability. Again, as a bond market, as a bond holder, bond investor, we like stability. We don't like volatility. So once things are sorted out, I think that's why foreign holders have actually put money back into the Malaysian bond market. And again, if you look at where the rates are, the return yield today of the bond market, it is very good in the Malaysian bond market. 4.7% is very, very commendable for just about 8 months into the year.
All right, thank you so much, Joanne. I would like to pose the next question for Bernice. So is ESG a trend for the Malaysia bond market? You're on mute, Bernice.
Yeah, thank you for the question, Shay. Can you hear me now?
Yes.
Right. Now, Malaysia, as far as Securities Commission Malaysia is concerned, launched the first ESG framework, market framework in 2014. Now, since then, more guidelines and framework and scheme has been launched lately. So the last being the SRI-linked Sukuk framework, which was launched in 2022. This is to enable companies to raise funds so that they can tackle sustainability concerns such as climate change or social agenda. Now, these are all this framework as well, this grant were launched basically to help companies in the relevant sectors to help them to in the transition to a low carbon economy. Now, is it a trend? If we look globally, it certainly is. In 2016, global ESG assets was only $22.8 trillion. In 2021, this number has increased by nearly 66% to $37.8 in trillion. And 2025, we expect it to be about 53 trillion. So it is, internationally, a lot of investors, especially institutional investors or corporate investors, have a mandate to have some ESG investment, ESG fixed income in their entire portfolio. Now, in Malaysia, this is picking up. As I mentioned just now, out of the 192 active ESG sukuk globally, Malaysia hosts 172 of them, which is close to 92% of it. And so we can see this is becoming a trend, or rather the investors is gaining awareness on the need of ESG investing. And I think another thing that's really supporting is the awareness of on ESG. People are more becoming aware of the environmental issues that we have, and therefore there is a need for ESG increasingly. So I know banks, they emphasize on ESG investing. So this is definitely becoming a trend, and we are seeing more and more ESG or SR sukuks being issued over the last few years.
Thank you so much, Bernice. I think we are running out of time at the moment, so let's do this one last question. I particularly like the next question by Raymond Link. I would like to pose this question to Joanne.
Oh, okay.
Earlier this year, we have a lot of American banks who go bankrupt, and that's probably due to the negative convexity of all the bonds that they purchase, right? So the next question by Raymond is that, do you have any insight about the bond's convexity? How a bond's convexity can be a better measure on a bond's sensitivity towards interest rates movements as compared to the duration?
Okay, I will try. Okay, so hi Raymond. So I think both factors are important when we invest into a bond, whether it is on duration, on convexity, whether it is a better measure on bond sensitivity. I think it is. I think a convexity measures, again, how sensitive a bond duration is to changes in yield. So they're kind of interconnected for both. But for the bond funds in Malaysia, I think what is easier to track is actually duration. And I think that's what explained by Bernice earlier, because duration is like a simpler measure to see how the fund or like a particular bond duration will be impacted by movements in the yield curve.
All right, thank you so much, Joanne, for addressing the last question. So for those of you who will still have questions on the panel, unfortunately, we are not able to address all questions at the moment. So we thank you so much for asking the questions on this webinar. So let me just take over the slide control. All right. So it has been a pleasure to be hosting both of you, Joanne and Bernice. So ladies and gentlemen, you just heard from Bernice Leaw and Joanne Gan, both of whom are from the Opus Asset Management. Thank you so much, Bernice and Joanne.
Thank you so much for having us tonight.
Thank you for having us. Thank you. Thank you, everyone.
All right, so for those of you who haven't checked out Bursa Academy, it is a comprehensive one-stop e-learning platform that aims to provide you with a continuous and holistic learning journey. Just scan this QR code or head over to www.bursaacademy.bursamarketplace.com for you to access information and knowledge about investing in Bursa Malaysia. For our next webinar, it is titled Trading Without Speculating in the Stock Market. Is happening on the 30th of August 2023, Wednesday, 8:30 to 10 p.m. So if you want to join this session, I've just given you the link in the chat box. You may register for this session if you want to learn how do you trade without speculating in the stock market. All right. So with that, I want to thank all of you here for staying here until the end of this webinar. Hope that you have gained enormous value learning from both our esteemed speakers today. I hope that you really enjoyed the session so far. So bye, everybody. Hope to see you in our next webinar. Thanks, Joanne. Thanks, Bernice.
Thank you, Shane. Thank you.